In 2008, the global financial system nearly collapsed. Lehman Brothers failed, markets froze, trillions of dollars vanished. Afterward, governments promised it would never happen again. New regulations were written, banks were stress-tested, risk models were rebuilt. For more than a decade, policymakers believed the system was safer than ever. But financial crises rarely come from the place you're watching. They come from the blind spot. And this time, the blind spot didn't look dangerous at all. It looked like innovation. It looked like efficiency. It looked like progress. It looked like AI. Not the science fiction kind. No robots, no superintelligence, just algorithms quietly making decisions inside financial markets. Algorithmic trading, AI-driven credit models, automated portfolio management. By the mid-2020s, somewhere between 70 and 80% of all stock trades in the United States were executed by machines. And those machines were fast, faster than any human trader, faster than regulators, faster than the systems designed to monitor them. But speed wasn't the real problem. The real problem was similarity. Most of these algorithms were trained on the same historical data. They used similar risk models. They reacted to the same signals, which meant when one system moved, the others moved too, at the same time, in the same direction. Physicists have a name for systems like that. They call them correlated systems. And correlated systems don't absorb shocks, they amplify them. The trigger, ironically, wasn't anything dramatic. No cyber attack, no sudden war, just 3 events colliding in the same 3-week window. First, the Federal Reserve signaled that interest rates would stay higher for longer than markets expected. Inflation had unexpectedly surged again, driven by climate-related disruptions across global supply chains. Second, commercial real estate finally cracked. For years, empty office buildings had quietly piled up across major U.S. cities. Vacancy rates climbed above 25%. Regional banks rolled over loans again and again, hoping the market would recover. It didn't. When 2 mid-sized lenders, one in Texas and another in Ohio, admitted they could no longer extend those loans, investors realized something uncomfortable. The losses had never been resolved, they had only been postponed. Then came the third signal. A large sovereign wealth fund in the Middle East began selling U.S. Treasury bonds. Not in panic, not in desperation, just a rational decision to fund massive domestic infrastructure projects. But markets don't always care about intentions, they care about signals. And that signal traveled fast. Rising bond yields, falling commercial real estate values, large treasury outflows. 3 separate warnings, all at once. The algorithm saw the pattern immediately, and they did exactly what they were programmed to do. They sold. Then the other algorithm saw the same signals, and they sold too. Within 72 hours, U.S. equity markets dropped 14%. Credit markets froze, liquidity evaporated. The VIX, Wall Street's fear gauge, spiked to levels not seen since the COVID crash. But unlike 2008, when the crisis unfolded slowly enough for people to see it coming, this one moved too fast. Most retail investors didn't realize what had happened until they opened their retirement accounts. That's where Marcus comes in. Marcus Reed is 41 years old, a logistics project manager living in Columbus, Ohio. He's not a trader, he doesn't follow financial news. For the past 6 years, he had done exactly what every financial advisor recommends. Max out the 401k, invest in a diversified target date fund, ignore short-term market noise, just keep investing. By early 2026, Marcus had saved $187,000. It was the most money he'd ever had in his life. For the first time, retirement felt like a fantasy. Then, the crash happened. In 10 days, $58,000 disappeared. But the market drop wasn't the worst part. Marcus's company relied on a revolving credit line to manage cash flow between contracts. When credit markets froze, that credit line vanished overnight. Payroll stopped. 2 weeks later, management announced a restructuring. 3 weeks after the crash, Marcus was laid off. Across the country, similar stories were unfolding. Unemployment claims surged nearly 40% in 2 months. Small and mid-sized businesses, the backbone of the U.S. economy, were hit the hardest. Marcus had done everything right. He saved, he diversified, he avoided debt, he followed every piece of conventional financial advice, and the system still failed him. Not because of his choices, but because of structural vulnerabilities he couldn't see and couldn't control. That's the part policymakers struggle with. The real lesson of financial crises is rarely the trigger, it's what the crisis reveals. This one revealed a financial system that had become incredibly fast, deeply interconnected, and increasingly automated. So automated, in fact, that the humans supposedly in charge had become spectators. Regulators were still preparing for the last crisis. They stress-tested banks, they monitored mortgage exposure, they checked capital ratios. But they weren't modeling the second-order effects of synchronized AI trading systems, or the slow-burning risks sitting on regional bank balance sheets. And it revealed something uncomfortable about how we talk about financial resilience. We're told to save, to invest, to plan for the long term. And those are good strategies in a stable system. But when the system itself has structural fragility built into it, individual discipline only goes so far. Marcus wasn't unprepared. He was prepared for a normal recession. What he wasn't prepared for was a correlated algorithmic sell-off, a regional banking credit crunch, and a sudden wave of layoffs all hitting at the same time. Now the political response is beginning. Congress is debating new oversight for algorithmic trading. The Federal Reserve is facing pressure to build better early warning systems. The IMF has called for more transparency from sovereign wealth funds. Whether any of these reforms actually pass is another question. History shows something interesting about financial crises. The reforms that follow them are almost always designed to prevent the last crisis. Meanwhile, the next one is already forming somewhere nobody's looking. Because in a system this complex, running this fast, there is always another blind spot. Marcus eventually found another job. 4 months later, lower pay, longer commute. He's rebuilding. He still contributes to his 401k, because realistically, what other option is there? But his view of the economy has changed. He used to think it was like the weather, something unpredictable, something you just prepare for. Now he thinks it's more like a machine built by people. And the question he keeps coming back to is this: if the system can break this easily, who exactly is responsible for making sure it doesn't? Right now, nobody seems to have a satisfying answer.